Hey, what's up guys? This is Ian. Welcome back to Show Me the Money. Today, I would like to talk to you about Apple, its current potential, future, and how can we invest in this company to ensure a good return and a very low risk. The aspects that we have to take into account when investing on a tech stock and how to correctly value it. Apple is probably the most famous US stock, the most valuable, and the one that more millionaires have made around the world, since it went public in 1981 at 13 cents per share, and nowadays is trading at around $115 per share. But what does Apple have or had that made it such a good investment? In 1997, Apple was on the edge of bankruptcy. They were producing personal computers that were clearly inferior to their competitors, at higher prices than them, and shareholders were completely unsatisfied because of more than 15 years barely making money. Until they got Steve Jobs back to the company. Then, one of his first decisions was to distance Apple from the production of personal computers to the development of new devices that would have less competitors. Today, the main business line Apple possesses is the iPhone, that accounts for 60% of the total sales. And in this market niche, they have the best product available, the most innovative, and the most loyal customers. It may be surprising that Apple only has 13% of the market share, but as investors, we have to understand that not always the market share defines or happens to be the key factor in a company. And in Apple's case, it's the profit per product where they stand out over their competitors and even other business models. With only 13% of the market share, they get 70% of the profits of the sector. Thanks to the premium and exclusive status of the iPhone, Apple is capable of charging a higher price for their product to customers who are willing to pay it for getting this status. But Apple possesses another business line that have been growing lately up to a 20% annual rate to the point of becoming an important source of income, the so-called services, that comprehends incomes from App Store, iCloud, or Apple TV, services that reinforces loyalty and becomes new sources of recurring billing. And the profit margin of the services line not only surpasses the one of the products, it even doubles it, as we can see on Apple reports. It is estimated that in the next 5 years, the profit obtained from services could even the profits from the iPhone. As the third line of business, we find the iPad, that represents 10% of sales. The iPad was the first product of its kind and ended up being the best of its niche. Recently, competitors have realized that they can't compete with this level of exclusivity, so have based their strategy on lowering the prices. Consequently, iPad has been left alone on its niche, inducing a recent growth of 20% in sales. The rest of the sales are divided between the iMacs with a 10% and the accessories, like the Apple Watch and the AirPods, where they have applied the same strategy based on the premium status and that have been growing at surprising rates of even 40% annually, gaining a market share of 30% from a zero of just 5 years ago. Another strong asset they have is its impressive cash and financial solidity. On their balance, they have more than $200 billion in cash. And good news, Apple is distributing this cash as dividends and share buybacks, increasing this way the earnings per share of the company. If we analyze the next graph, it's evident the effect this policy has had over the last 8 years, reducing the number of floating shares and increasing shareholders' remuneration as a steady growing dividend, from no dividends at all in 2011 to more than $3 per share during this year. And during the same time, the revenue boosted from $108 billion to almost $300 billion, with the best margins in the tech sector. However, when analyzing a company, the risks have to be considered as well. And with Apple, the biggest risk we can see on the horizon is what we call innovation risk. Today, Apple products have no real competence. They are the absolute leaders of their market. But innovation is something that can never stop. So Apple have to keep investing on always being steps ahead of any competitors. We all have in mind the previous cases of Nokia, that went from dominating the market to almost not exist, or Kodak, that wasted their opportunity of revolutionize their sector when they thought that digital cameras will hurt their photo roll sales, only to finally go bankrupt in 2012. A secondary potential risk that sometimes concerns the investors is the trade war between the US and China, that seems continuously to be on a roller coaster of tensions and can hurt the sales of the company on the huge and emerging Chinese market. When valuing tech companies, the best indicator should be the PE ratio. If you don't understand what it is, you can check the video I'm leaving down in the description. Apple is trading right now at around $115. They estimate to earn almost $4 per share at the end of this year. And for these types of stock, I always recommend to think with a 3-year term at least, and then try to calculate what profits could the company produce, taking into account its growth. For the next year, Apple estimates to earn almost $5 per share at 20% growth. So for 2023, the earnings per share could be around $7, being conservatives. In cases like this, when investing in a company of this level of quality and with a very predictable business, it's perfectly justified if it trades at a PE ratio of 20. Right now, Apple is trading at a PE ratio of 35 and a return on equity of 70%, showing off how effectively management is at using the assets to create profits. At these ratios, if we take those $7 per share and multiply it by 30, a slightly higher ratio than the sector that is perfectly reasonable due to its higher growth rate, we have a value of $210, which have to be added to the $12 per share Apple have in cash on hand, giving us a target price of $222 per share, to be expected between 2023 and 2024, a 93% growth on our investment, and that is without accounting the small amount of dividend the company pays that could sum up between 1 or 2% more of profit. And if we talk about risk, Apple is widely considered a 7.0 risk score company in a range between 0 and 10, in which 10 is no risky at all. Being Apple the biggest company of the world, at least in terms of value, it happens to be a must-have on portfolio in times of few opportunities of entrance and a very low risk method of beating the inflation, the market overall growth, or any high interest savings account. So that's it for today, guys. Thank you very much for watching this video. Please subscribe and hit the like button if you enjoyed the video, and see you in a couple of days.